Hello, credit union executives. Welcome to See You on the Show, where we give you up to date information on how you can reduce risk, keep key talent, and take a strategic approach to your personal financial wellness. Hosted by me, Doug English, a certified financial planner and former credit union insider with ACT Advisors. JP O'Connor, welcome to See You on the Show. I am delighted you have joined me today, and I know you're going to bring us a bunch of really interesting information.
Yeah, thanks for having me.
So, JP, tell us about how you got started working in the credit union movement, and then what kind of work you are doing today.
So, growing up, I knew what credit unions were, but honestly, I couldn't tell you how they were different from big banks. And then fast forward, I took a consulting job at DDJ Myers, and one of the first things that Didi, the founder, emphasized was understanding the credit union movement, not just the what, but the why. And it was a game changer for me. But the key moment, I'd say, was my first GAC, Governmental Affairs Conference. So I walked into this massive event and I just felt the passion. I heard these incredible stories of what credit unions were actually doing for their members. And I met so many genuinely passionate people, yourself included, Doug, who deeply care about and protect the movement. And it was like a light bulb, it just kind of clicked. This isn't just an industry, it was a movement with a soul, and I wanted to be part of it.
Exactly. Yeah, there is definitely something special here. So, what kind of work are you doing these days, JP?
So right now I'm specializing in executive compensation consulting with Park Compensation Consulting. And we really like to start with the compensation philosophy as the core of all the work and build off into conducting analyses, looking at executive pay packages, providing retirement analyses, and just full on compensation consulting services in general. We might dabble into whole org here and there, but specialties in executive comp.
Well, I know that's kind of been part of our numerous discussions we've had over the years. We've known each other, and one of the things that you'd said one GAC, which was that some data that you had looked at talked a little bit about how some of the background of the board predicted CEO comp, which I thought I'd never heard anything like that before. Talk to our listeners about, what was that data? Help us understand what you're talking about and what that might mean.
Well, I think it goes without saying that our backgrounds as individuals shape our willingness to make certain decisions. And relating that to CEO compensation, there's a growing body of research that underscores the impact that board demographics, etc., have on how CEOs are paid. More specifically, there's a study from the Journal of Financial Economics, and it reveals that directors' experiences and personal characteristics influence their decision-making processes regarding executive pay. And in other words, we are who we are because of our experiences, and those experiences shape the decisions that we make, consciously or unconsciously. And that's Psych 101, but applied to compensation here. And I see this all the time with credit union boards, where they come from within the field of membership, their unique perspectives are going to be shaped by their industry and personal journeys. And that directly influences how they're going to approach CEO compensation, executive compensation. And sometimes those personal influences are magnified. And compensation decisions they're complex. They're more than just financial. They reflect the board's values, priorities, even its comfort level with certain approaches.
So if you are a credit union CEO and you're already in a position, your board is what it is, and you've got to kind of work with that. And I know that I've over the years of the credit unions that we work with, you often hear challenges about the difference between the comp level that you have to pay in credit unions to get talent versus what they were used to with the phone company or with the state government or with whatever the employer group may have been that the credit union was founded on.
Mm-hmm.
what are the takeaways? Like, how do you deal with that? How do you deal with it if you're a CEO in that situation? How do you deal with it if you are someone that is considering changing credit unions, and how you might evaluate what kind of credit union you want to partner with?
That's a really good question, and it's one that doesn't have a one size fits all to it. There are a number of ways you can approach that situation. I think it really starts with talking to the board and understanding their perspective. And that actually kind of brings another layer into play of, again, how directors and their personal financial experiences are going to shape their willingness to how they pay the CEO or other execs if they're controlling that. And there are studies that examine wealth and decision making as well as my own personal experience. And I've seen that boards, for example, with wealthier directors or who come from higher paying industries, they approve more generous compensation packages typically. And it's not just about paying more, it's about paying right. And regarding socioeconomic backgrounds, I found the opposite to be true as well. So, kind of like what you were saying, directors from more modest financial backgrounds are often less willing to pay at or above the market. And I think a good example actually would be I worked with a $600 million credit union, give or take, and their board was made up of, we'll say, highly tenured individuals from modest financial backgrounds. And they were just convinced that paying the CEO above a certain number was excessive. And we explored that, and where the number came from, it turned out to be tied to their own career experiences, decades old pay levels that no longer reflect today's market. And so when I modeled the data, I actually backdated the final pay figures to around the time that most of the board was still working. And the numbers align much closer to what their imagined number was. I'm not saying this is necessary to do, but in this case, it really helped them to reach that aha moment and allow them to see that their assumptions were rooted in kind of personal experiences rather than current realities. So using data to drive the reasoning, to drive the, we'll call it the argument, is really the best option because for as far as a CEO or other executives know, it's the data is the data. So you might think that, oh, I'm underpaid or overpaid. A third party, for example, will have no stake in the game. You do the analysis, you run it across a multitude of sources, and the data speaks. So in that case, for example, it was just as simple as asking the board, where is your thinking coming from? Let's look at some data, reevaluate our approach to compensation potentially.
So if I heard you correct, I want to make sure our listeners catch this as the takeaway, is that you took the CEO's comp and then you related it to where their comp was back when you evened the time frames, right? Because they used to be working, now they're retired. You took the CEO's comp and inflation and reduced it for inflation, and then it made more sense to them. Is that the main change you made, is time value of money?
Spot on. Yep, that's exactly, and it's something I would say I've actually only done a couple times, but in certain instances, if there's just a made up number and you're just thinking, where do I even start with that? It's just I don't know where the number came from. It just doesn't seem right.
Mhm.
Anything above that doesn't feel right. You got to start and reason with that perspective. So,
Yeah, and then I've heard actually some guests on this podcast have talked about how do you talk to your board about executive benefits,
mhm.
because again, if they are state government employees or folks from the airline industry, they probably have pensions, and those pensions maybe replace 50% or 60% or 70% of their working income, maybe inflation indexed for life.
Mhm.
And then when they're looking at the CEO's comp, it's a much larger dollar figure, but they forget about that inflation indexed pension that they've got, probably along with healthcare, that has a very, very substantial effect on their overall lifetime income. Do
Yes.
you bring that into the conversation or have suggestions for how our listeners might do that?
Absolutely. And I think I know that this goes both ways for boards and CEOs. I'll start with the idea that education in and of itself can be a game changer. So understanding the norms and the trends in CEO compensation is going to help boards and CEOs see the big picture, and it reduces the impact of those personal biases. But then there is a multitude of surveys that have data on these different components, like is a pension plan common, is it not? You know, what's the targeted replacement ratio? Because you got to think about what the function of a SERP is, a supplemental executive retirement plan in the first place. And so when you look at the holistic picture of what the CEO is getting paid, you have to consider every component. And if you can't find data on dollar signs, you could definitely relate it to what's affordable, what's feasible, what's part of our philosophy, and then, where do we pull certain levers to make it all balance out?
Yeah, there are CEOs possibly listening to this podcast that are in this situation already. They work somewhere, the board is full of folks with, the sort of lower income, middle income background, and they're challenged to get that conversation going without seeming like it's all about me, right? It's really about, as you said, to let the data talk about what fair compensation is. What have
Right.
you seen as far as best practices for how to get that conversation going and not have it just seem like it's a self-serving conversation?
So I guess we could start with the reality that in a way it is self-serving, but it's fair. You know what I mean, though?
Yeah.
It's like that you're underpaid, and it doesn't feel, and we all know, or most of us know, it doesn't feel good. You could imagine if you can see 990s, for example, it's public information. You know what your buddy down the road is making, and you can see what you're making. If there's that disconnect, for whatever reason, the board may have lost sight of that. They might not even know that. And so it's different for every circumstance. I'll just use the two examples, in which case, if there's a board that is not aware of it, I think the solution is right there, is just figuring out, okay, well, what data do you need to see to move that conversation forward? Because I'm looking at data that seems to support the idea that I am underpaid. There's the other side of the coin where the board is aware of it. And for example, like the $600 million credit union I'd mentioned, they're aware of the data. They just think for some reason that those figures either aren't right, or they're not fair, or they're not affordable, or all of the above. Again, the data is the place to start, or at least start the dialogue in terms of making a change. But getting in front of the board is going to be uncomfortable. Asking them, hey, can you look at this data? I think I'm underpaid, for a lot of people is just uncomfortable, but it's what it takes. You really do have to just say, can we talk about this? I'm comfortable with using a third party or whoever you're comfortable with. Here are the sources I've come up with. Here are the sources they've come up with. Let's put something together and look at this objectively, or as best we can, is really the way to take it.
So let's pretend that you do that. You think you might be in that situation as a leader, so you reach out to you, and you say, "All right, JP, I want to have this discussion. I want to have this discussion and education process with my board, and just see where the comp is, how it fits with our strategy, and what adjustments, if any, we need to make." So if that conversation starts, I assume CEO and you, what are the next steps? Where does it go from there?
Kind of comes into governance. If you have a compensation committee, for example, which a lot of larger size credit unions do, you definitely want to rally them together. If I'm on the board and I receive the message, I'm going to try to gather the comp committee and open them to the same idea. Let's assume that for whatever reason the board is closed off to the idea. That's just the situation that, again, it's so contextual that the truth is there is a reason, and addressing that reason with, and I'm going to say it time and time again, data is the way that we have to approach it. I think the example you're asking is more along the lines of the board is open to it, right? Is that what your assumption is?
Yeah, it's the CEO reached out to you and said, I want to engage in some kind of compensation consulting. How does this work?
Mm.
And then what does an engagement look like? Like how does this work? How do you determine? And then from how does it work to then what's the next step? Is that then
Oh,
you're initially engaging with the CEO, and then I assume you move over to the comp committee.
so I actually like to start with the comp committee or the chair, whoever wants to be the point of contact, and understand their point of view, because at the end of the day, it's the board setting the CEO's pay. So we're conducting the analysis on behalf of the board, the credit union, the members, etc. And that's the first insight that we want to have provided to us. And so they'll give us background, they'll spill the beans, they'll tell us all the history and their philosophy and what they're thinking and where their expectations have been and why there might be a disconnect in what the CEO's expectations are and then what's being offered. And then we'll move on to the CEO and kind of do the same thing and just ask, what do you think is going on? And then we plop this beautiful compensation analysis right in the middle and we start talking about it and we say, well, you think this and you think this. Here's our here's our assessment of that and here's the report and here's what the data says. And that's where the conversation obviously moves forward from.
And then I know you and I have had many conversations about the challenge of getting the value of executive benefits into that conversation, because they come in different varieties, and turning them into a present value can be somewhat challenging, and then very difficult for folks outside of the industry to understand. How do you incorporate executive benefits values into those discussions?
There's a lot of different ways. Starts with survey data, starts with a deeper analysis of the numbers where you can find them. Then you can look at what's affordable to the credit union. Is there a budget? What constraints are there, right? You have to look at the boundaries. And then we look at market practice. So we consider, okay, what's most common? And to be honest, is a country club membership even a value to you? Just naming an example there. Um, what's a fair replacement ratio in the board's mind? And then what is the market consider as fair when you look at that data? And that's actually pretty easy to find right now. It's typically around 60 to 70% is
That's what I
what.
see. All very consistent.
Yep.
That's what I see.
And that's the at least one of the numbers we can all agree on is that's right where the range is. And so you just build maybe backwards from that and you take what you already have in terms of the 401ks, the pensions, etc. And then you see, well, okay, well, what needs to be supplemented here? What do we need to add? And then also one thing I see run away sometimes is keeping up with the changing salaries. And that's why it is actually very important to do a market analysis, especially in the midst of this, so you can see, okay, is a big adjustment already needed before we've put a plan in place, etc. So that's a whole different rabbit hole right there too.
So the fix, if I can kind of go back to my question before, you're an executive and you're in the credit union where you're feeling like your board is challenged to open their eyes to adequate compensation for the market that we're in today. What you want to do is get the conversation to a third party consultant that can do to bring the data into the discussion. And the discussion isn't about me, it's not about you, it's about what is the fair compensation data in this industry at this asset size in this regionality. And that is where you start to hopefully get the director's economic background, at least not so much in the foreground of
Mm.
discussions. Is that right?
Yeah, I'd say the only thing I'd add to it is the real value of let's just say using a third party comp consultant. It's not that we can get data that's different than what the credit union can get, boards can get, CEO can get. There's just for one, there's no bias. I'm not advocating for higher or lower pay. There's different methodologies is another one. It's how you use that data. And then it's also just the fact that we're working with hundreds of other credit unions and have worked with, and so there's market trends that happen that aren't on paper. And so we don't necessarily want to be armchair, you know, consultants. We're actually in the field talking. We can see the intricacies of the conversations that lead into creating these pay structures. And so thankfully that helps kind of trigger some pay model ideas when we start to hear what's going on in the background.
In the data, have you ever seen, is there any correlation between the pay of the executive team relative to the industry and the growth of the credit union? Is there a correlation there? And is it a strong positive correlation or otherwise? Do you know?
So to clarify, we're saying, is there a correlation between the overall pay dollar amount of the executive team and then the asset size of the
I was thinking rate of growth,
rate of
but
growth? Okay.
asset size, I know the answer to that one. That's a strong yes.
Right. I would say without actually doing the analysis, I would assume that there is, I'd say slightly positive correlation. Keep an eye out. I'm actually writing an article as we speak about something like that. And it is interesting how, executive pay is going up and up and up, but it's not just executive pay. It is everybody. It's middle management, entry level. Pay is just moving around. It's acting in different ways than we've seen it act. And so, if a credit union is growing and they have a strong growth, I would say the best practice would be for the executive compensation to track that and tie into that. But that's not always the case. So
Mhm.
I think
Yeah.
it's different.
It depends on if that's what the board's after, right? If they're
Yeah.
driving for exceptional growth, then they're going to have means of increasing comp in leaps and bounds. So go acquisitions, which we talk a lot about on this podcast, cause the assets of the credit union to explode potentially, and with that, the normal comp systems are just not going to keep up.
Right there, yeah. We just want to be able to see the data and see, is this fair, is it not fair? And that's again where we can sometimes run into disagreements of, hey, we're killing it. We're top of the percentile of our peer group, and we are getting paid, below the median of the peer group. That's those two things don't add up. So it is best practice to align the performance of the organization with the way it pays.
Now, another thought I had, I wondered if you had seen sort of a philosophy around board makeup to try to reduce biases of this sort, where if everyone is from the same employer group, then you would think a similar bias based on their economic experience versus kind of diversifying that employer group, which I recognize that may or may not be possible if that's who's there. But have you seen any kind of board governance designed sort of board makeup to diversify that background?
From what I have seen, I would say that diversity on the board is always a good thing. It always adds perspective in terms of compensation. Um, I will just say as well, I'm not an expert in boards in general, so I'm hesitant to answer because that's not my area of expertise per se, but I do
That's a
know,
good answer, JP.
yeah.
That's a good answer.
But in terms of compensation, I have from just recalling, some of the most recent clients, and I would say the more diverse boards, they do have more meaningful discussions, especially when you're putting together a philosophy of why do we pay this way? What are we paying? I have noticed that more diverse boards, they go deeper, you could say.
Yeah, it would make sense. Less groupthink potentially.
Less groupthink is yes,
Yeah,
exactly.
very good, JP. As expected, I always enjoy our conversations at whatever credit union meetings we're attending. And when you brought up this correlation you'd seen in the data between boards' historical comp when they're working and executive comp, I thought we should grab that and talk about it on this podcast. So, any final thoughts for our listeners about this topic?
Yes, I would say at the end of the day that objectivity is the goal. Recognizing that there are psychological factors at play, and it's not just dollar signs and data on a paper. There's a person behind it. So balancing that that psychological background with the data is really going to help towards creating fair compensation practices. Uh, yeah, when boards focus on the data, they can create pay structures that don't just reward the CEO, but they support the credit union's long-term success. I think that's the real takeaway is using data to drive those decisions.
You recently has a child, JP. Did you name your child Data by any chance?
So surprisingly, no. And
No,
in
no.
hindsight, I think I should have at least snuck it into his middle name. But yeah, I think it's a little too late for a name change. I guess we just have to have another. I'll tell Gavin.
Tattoo, maybe a tattoo, maybe a tattoo.
Tattoos, yeah, those could work. Yeah. Anyway,
JP O'Connor, thank you so much for joining me today. Thank you for your work in the credit union movement. We will look forward to our next conversation.
fantastic. Thanks for having me.
That's all the insider credit union knowledge we had for this episode. Are you enjoying the conversation? Be sure to subscribe and share your thoughts with other credit union leaders by leaving us a review. See you next time on See You on the Show.
The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual security. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Economic forecasts set forth may not develop as predicted. All performance referenced is historical and is no guarantee of future results. Indexes are unmanaged and cannot be invested into directly.